Okay, everybody, it's me, Gregory Mannarino. It is Monday, August 29th, 2022. Let the festivities begin. People, what am I talking about? Yet again, in our freaking face, we have instability in the debt market. How can we see this? Let's step back a moment before I, elaborate. The bond market or bond yields are not supposed to jump around like, for example, a stock does. They're supposed to remain stable. They're supposed to be stable investments for people. You understand? People do invest in bonds here. So we have a 10-year yield right now as I am doing this video blog, 3.10. We ended Friday at 3.03. So here we go, another clear sign that we're having a sell-off here in the debt market. And the stock market appears to be about to sell off as well on the back of that. What is the market seeing? What are market participants seeing? It should be as clear as day. Instability in the debt market. And being that you and I understand, everyone should know this, that this all hinges, people, on the debt market. This entire freak show from stem to stern, upside down, backwards and sideways, everything hinges on action in the debt market. Why do you think, yet again, I ask the same question all the time, central banks have chosen to do what they are doing, that is, rig the debt market to the highest possible order since the meltdown of 2008. It's all to reinflate bubbles, to create the illusion that things are good. Look, the 2008 meltdown here, that was it. It was the party over moment for everything. I'm the guy who first started saying that. I know other YouTubers have used that, but I coined that phrase. And it's really been over since that time. This market makes no sense. There's no price discovery behind a single asset today. It's all distorted and twisted. There's no resemblance at all whatsoever of a free market, nor do we have a free market economy. It's all just a freak show here on the back of the Federal Reserve here managing the market. It has caused distortions that are going to correct. Now, being that we are seeing clearly yet again instability in the debt market, it's got the stock market spooked. Stock futures are lower across the board. Stock trading doesn't start for about 35 minutes from the time I am doing this video blog. Futures are lower across the board as the 10-year yield is rising or bonds are selling off. You understand? So as usual, we need to keep our eyes on this here. What do I expect to happen? Look, I've told you this already. I expect central banks to do more. Will they? I've been explaining to you that I believe the usual phenomenon of the markets and energy is going to play out. That is, prior to every midterm election, you get a propping up of the stock market, at least an attempt to do so, and energy prices which become artificially suppressed by some twisted mechanism, so people think the current administration really wants to help. You can't make this stuff up. It's all a game, people. Seriously. So, on the back of debt market action, clearly instability here. Instability. It's early. Only had one cup of coffee so far. So, on the back of that, stock futures lower, dollar slightly lower, which is a little bit of a shocker. Okay. Crude oil getting bid higher. Bitcoin hovering around 20,000. It did break below my 21,000, which I was watching for a long time here. So I'm going to sit back. Like I said yesterday, I explained this to you. If you saw my markets a look ahead, I'm not buying anything right now. I want to sit back and watch. Okay. With regard to gold and silver, of course, despite the dollar being weaker, not by much this morning, you have gold and silver under pressure. Good. Let them play their games. We're going to continue to play our games. There is no way on this earth, off the earth, or anywhere else that global debt is not going to continue to balloon. More schemes between policymakers and central bankers are going to come up here to continue to pull cash into the now from the future. It's an insane mechanism here. in order to keep the Ponzi scheme going, and that's all this is, again, it's a Ponzi scheme, which every Ponzi scheme requires another investor or a greater investment into it to make it run. So the Federal Reserve clearly is running a Ponzi. And with their mechanism or the collusion between policymakers and what the Fed needs to do, which is continue to inflate, they create reasons out of thin air to continue to borrow. Inflation Reduction Act, funneling wars, this project, that project, whatever it might be. You know, people sit back and they wonder, hey, why is it that my senator or whatever is voting to continue to spend or spending money on this pet project? Because they understand that's what they have to do to allow this system to function. Because without it, it's just over here. People don't understand it. They're not taught this stuff in school. They never will. The debt is never, ever, ever meant to be paid back. It's only meant to be continually and relentlessly expanded on. That's the truth here. And that's the only way the debt-based economic model can function. It's a Ponzi in the most literal sense of the word. Understanding that it's a Ponzi and the debt must expand exponentially. Every single president, as I have covered for you, must outspend the previous president. Has to happen. That's just the way it is because the debt must expand exponentially. You all know that. So you want to be on the opposite side of the trade. I don't care what they do to physical metals, gold and silver, although it's an upside down system. Just imagine for a moment a system where a hard asset derives value from a derivative. Yeah, that's what we have here with regard to the precious metals market. And that's only solely because banks like JP Morgan continue to rig it, and they're going to continue to rig it until they can't. And the moment when that's going to change is when the debt market fully implodes. Right now, there's instability that we're seeing in the debt market, and it clearly is instability. Like I said, bond yields are not supposed to jump around erratically. They're supposed to be stable for the most part. And we've seen anything but that. It's been completely out of control. I mean, we witnessed the 10-year yield spike to over 3.5% a month or so ago, whatever it was here. And you saw what that did to the stock market. Took a pretty big hit. Well, that's what I sincerely believe. And I could be wrong, again, but most of you seem to agree with me on this one that the Fed's going to do more. Are they ready to allow this thing to implode? Because mark my words here, once that debt market lets go, once it really lets go, and you start seeing yields spike out of control, 3.10, 3.25, 3.5, 3.75, 4, bang, bang, very rapidly. It's not really so much the number, okay? It's the pace at which it's rising that is the real key, because that mechanism, watching that yield rise like that, shows that debt market is melting down. People are running for the door, trying to get out of here, get out of it. And the same thing's going to happen to the stock market. Understand, when you got that sell-off here in the debt market, which is going to happen. I mean, watch the 10-year yield, maybe better yet, watch the MMRI, Mannarino Market Risk Indicator. It's all tied together, okay? Link in the description of this video. Once we see that, I mean, it's just done. The whole system is just completely done. And the stock market is going to fall so fast, people's heads are going to spin around like the freaking Exorcist. I've said that many, many times. And I think you get it. You understand what's going on. But look, if you understand, you and I, that this entire thing is just a farce. It's what have I said? It's a house of cards built over a pool of gasoline, okay? And it's going to go off. And this whole thing is going to get so real, so fast. I think people are going to be taken by surprise. But the key here, you and I don't really have to guess, like I've told you repeatedly as of late. If you and I realize that it all hinges on debt market action, and we realize right now the debt market is unstable. that should raise some red flags. If in fact, let's say the end of the day, tomorrow, you start seeing, and I covered this yesterday in my Markets and Look Ahead. If you haven't seen it, check that out. If you start seeing bond yields drop, that's central banks, that's the Fed getting in here, buying more debt, and that's going to send a signal to the market. Hey, okay, it's all clear, buy more stocks, and then you're going to see the stock market rise. So 10-year yield drops in this scenario, okay, you're going to see the stock market rise. 10-year yield rising, again, in this scenario, you're going to see the stock market take a hit. Could be substantial too. All right, so just sit back, take in the situation, realize what you're doing and why you're doing it. If you're a stacker like myself, you're holding physical assets, silver, my all-time favorite, you realize that you're using it as, it's a unit of wealth, okay? It's not a unit of debt. And you're holding these things here, okay? Because you realize at one point, cash is just going to move. Debt market implodes, which will pressure the stock market. And cash, again, doesn't grow little money wings and just fly away. It's going to move into hard assets, okay, and commodities in aggregate. And you're going to see inflation like you can't believe. So all this nonsense about, the Fed's serious about fighting inflation, they're going to continue to raise rates moving forward, it's bullshit. The Fed has been raising rates, and inflation is still surging out of control. They're going to sell you that lie until you choke on it. Seriously. All right, I'm out of here. Love you a lot. Ponder these things. Please comment, and I will see you at the end of the day.